As much as I'd love to buy stocks and hold them forever, let's face it, that's not always the smartest move. Sometimes, it's about rebalancing, taking profits, or redirecting money to better opportunities. And today, I've got a shocker for you. I've sold out of Apple. Yes, Apple. Stick around as I reveal the 2 stocks I'm buying with those funds, and why they could outperform Apple moving forward. Trust me, you don't want to miss this one. Hey everyone, Ernest Robinson here, back with another video. As a quick reminder, I'm ACA and MBA, not a financial advisor, so always do your own research before making investment decisions. This channel is only informational and educational content. Now, here's the deal. Apple has been a phenomenal stock for me, delivering impressive returns over the years. But when valuations start to get stretched and growth slows, it's time to reassess. So in this video, I'll explain why I sold Apple, walk you through its fundamentals, and reveal the 2 growth stocks I'm investing in instead. When it comes to buying or selling stocks, research is everything. But let's be real, it can take hours, if not days, to gather all the data you need. Alright, let's talk Apple, one of the biggest companies in the world, with a market cap approaching $4 trillion. Over the past 5 years, Apple's stock has climbed over 225%, and I've enjoyed the ride. But here's why I'm cashing out. 1. Slowing growth. Revenue growth has been lackluster. 1. After a pandemic-driven 33% growth in 2021, we saw just 2% growth in 2024. 1. Free cash flow? 1. It's huge, but it hasn't grown meaningfully in years. 2. Stretched valuation. Apple's forward P/E ratio is a staggering 33 times earnings, higher than Nvidia, which is growing much faster, and far above Alphabet, which trades at just 21 times earnings. These metrics suggest that Apple's valuation has outpaced its fundamentals. So, while I still admire the company, I believe my money can work harder elsewhere. First up is Uber Technologies, a stock that's been unfairly beaten down over the past few months. Shares have dropped nearly 25% since October, thanks to overblown concerns about robotaxis and competitors like Tesla and Waymo. Here's why I see opportunity. 1. Massive growth potential. Uber is expected to grow earnings by 23% in 2025 and 42% in 2026. 1. Compare that to Apple's low single-digit growth, and it's clear which stock has more upside. 2. Dominant market position. Despite the noise around robotaxis, Uber remains the leader in ride-hailing and food delivery. 2. Partnerships with companies like Waymo further strengthen its position. From a valuation perspective, Uber trades at a forward P/E of just 28, with a PEG ratio of 1.2. Analysts are bullish too, with a 12-month price target of $94, implying 40% upside. For me, Uber is a no-brainer for growth-oriented investors. Let's talk numbers. Uber has seen explosive revenue growth in recent years. 1. 2021, up 57%. 2. 2022, up 83%. 3. 2023, up 177%. And here's the kicker. Uber recently turned free cash flow positive. This is a critical turning point for any growth company, as it signals financial stability and profitability. If you're looking for a stock with strong management, massive growth potential, and a beaten-down price, Uber deserves a spot on your watchlist. My second pick is Scalar, a leader in the booming cybersecurity industry. With cybercrime on the rise, demand for cutting-edge cybersecurity solutions is skyrocketing. Here's why Scalar stands out. 1. Strong revenue growth. Over the past 5 years, Scalar's revenue has grown at an average annual rate of 50%. 1. Even with slower growth projected, analysts expect 20% growth over the next 3 years. 2. Improving margins. While Scalar isn't fully profitable yet, its EBITDA margins have improved from 30% to nearly break-even. 2. Once profitability kicks in, we could see significant momentum. Scalar trades at a forward earnings multiple of 52 times, expensive, yes, but not unreasonable for a company with its growth trajectory. If you prefer a more conservative metric, its enterprise value to sales ratio is just half that of CrowdStrike, a key competitor. What's exciting is that analysts see Scalar's stock climbing 20% in the next 12 months, with a price target of $228. For investors willing to take on some risk, this could be a high-reward opportunity. Now, let's stack these companies side by side. 1. Apple. A mature company with minimal growth but a stretched valuation. 2. Uber. A rapidly growing company in a dominant market position, trading at a discount. 3. Scalar. A high-growth disruptor in a critical industry with plenty of runway ahead. It's not that Apple is a bad investment, it's just that I believe Uber and Scalar offer more upside at this stage. So, what do you think? Was selling Apple the right move? And what are your thoughts on Uber and Scalar? I'd love to hear your opinions in the comments below. If you enjoyed this breakdown, please hit that like button to support the channel, and don't forget to subscribe for more insights like this. Thanks for watching, and I'll see you in the next video. Take care.